In this video, we'll discuss 6 main market types that every trader should be aware of. Knowledge of these different market types should inform every decision that you make as a trader, because they'll give you a better understanding of where the possibilities are, and this will help you make more informed decisions in the market. All right, let's delve right into it. To a man with a hammer, everything looks like a nail. I'm sure you've heard of this before. It's a catchy little saying that describes the idea that a hammer is not the most appropriate tool for every purpose out there. Yet a person with only a hammer is likely to try and fix everything using that hammer, often without even considering other better alternatives. As a trader, you have to be cognizant of that tendency, because one trading strategy or system won't make money under every market types. All right, this is just a fact. Different market types, different market conditions require different strategies. And one of the biggest errors I see traders make time and again is trying to make money in different market types with one strategy. And then they beat themselves up for not being able to. If you want to trade different market phases, different market types, ideally you want to have different trading strategies that are better suited for the job. Don't just use a hammer for everything, Now, let's identify the different market phases. First, there's what we call the slow grinding bull market. This is an upward moving market that has steady momentum behind it, with price action displaying the typical quote-unquote staircase pattern, higher highs and higher lows. When you trade this kind of market, you want to use a strategy that looks to buy on the dips into key support levels, or buy on breakouts above recent highs. Very, very simple. The second type of market is the volatile bull market. This is also an upward moving market, but it has explosive momentum behind it. Powerful impulses, a runaway kind of price action, which means large bullish candles. And this type of market offers very little retracement and only particularly brief periods of just pauses, which you can only see on the lower time frames. And since retracements are few and far between, and price tends to not test broken former resistance levels, the ideal trading strategy for that kind of market would be to, of course, hop on board the trend before it even begins. But this is not always possible. So what you could do is use the lower time frames to identify whatever brief dips there are there, and place a trade with a tight stop under support. The third type of market is the slow grinding bear market. And this is a downward moving market that has steady momentum behind it, with price action displaying the typical, down the stairs kind of pattern, meaning lower highs, lower lows. And when you trade this kind of market, you want to use a strategy that looks to short on the rallies into key resistance, or sell on breakdowns below recent lows. Fourth is the volatile bear market. This is also a downward moving market, but it has explosive momentum behind it, which is to say large bearish candles. And this type of market offers very short relief rallies and only particularly brief pauses, which you can only see on lower time frames. And since relief rallies are few and far between, and price tends not to test broken former support levels, the ideal trading strategy here would be, as with the volatile bull market, to hop on board the trend before it even begins. But that is not always possible. So what you could do is use lower time frames to identify whatever brief rally there is, and place a trade and place a tight stop above resistance. Fifth is the quiet sideways market. Now, quiet sideways markets are ranging markets which are very low volume and generally directionless, though sometimes there's a very slight bullish or bearish drift. This type of market is characterized by very shallow and choppy trending ranges and is generally comprised of many short candles, indicating the lack of movement per session. You typically have that kind of action around the December holidays. It's a low opportunity type of market, as the lack of momentum means the range is very shallow. And so even a typical range reversal strategy, whereby we look to fade support and resistance, this tends to be low yielding, as there is simply not enough movement to profit from. When conditions are like this, it's best to take some time off for yourself, to just be with family and to go on vacation. And then finally, we have what we call the volatile sideways market. And this type of market is ranging as well, but it's much higher in volume and volatility. And though it's still directionless, it can also feature a slight bullish or bearish drift, with price essentially just rotating back and forth between support and resistance levels. There's ample opportunity to operate a range reversal trading strategy, whereby one buys support and sells resistance, or sells support and buys resistance. And ideally, you want to identify potentially volatile sideways markets in their early stages, because often what you'll see is that after 4, 5, 6 consecutive support and resistance hits, the market will eventually break out. So all in all, I would say it's very important that you understand those different market phases. Once again, slow grinding bull market, volatile bull market, slow grinding bear market, volatile bear market, quiet sideways market, and volatile sideways markets. And these different market types can usually be identified in the glimpse of an eye, really. There's no need for complex analyses here. Seriously, a kid could identify those different market types. But once identified, this will provide a framework for you to be on the right side of the market with your trades. In other words, you won't be fighting the tide, you won't be fighting the trend. Doesn't mean that you won't have any losses. I want to be very clear about that. That's not what I'm saying at all. What I'm saying is that generally speaking, if you trade in the direction of the trend, if you place and manage your trades while being cognizant of the direction of the market and its current range, you're more likely to find yourself in profitable trades. And that's all it is. It's being on the right side of the flow of the market makes you less likely to get stopped out of your trades unnecessarily. Okay? And what's more, it helps you set your expectations properly, so that you're not expecting something that has a just low probability of happening. So remember these market phases, and make sure that you're using a strategy that's better suited for each one of them. Don't use a hammer for everything. Find a better tool and use it. Okay? And 3 more things. Number 1, know that you don't have to trade all these different market phases. Okay? You could decide to focus on one and specialize there and develop an expertise in trading that particular kind of market. And just take vacations when the market is not favoring your particular strategy. That's also a good and viable option. You push the gas pedal when it's easy for you to make money, and you release it when it's hard for you to make money. And second, you must be crystal clear about what your strategies are. You might need to have a different trading plan for each strategy. And once again, having a plan can also mean doing nothing. As a trader, you have to pick your battles carefully. This is part of the game. Picking your battles carefully. You have got to know where you have an edge. You have to know where that edge resides. And you have to protect what you have. This is absolutely central to good trading. Survival, survival, survival. This is your imperative, all right? Survival. And finally, number 3, there are instances where it pays to be contrarian and to bet against the trend. Contrarian trades have a low win percentage, but when they work, they're explosive in terms of profit potential. Because essentially what's happening is that you're getting to onboard a volatile bull market, let's say, before it even begins. But this is something you'll have to experience with and learn by yourself. You have to increase your knowledge of technical analysis, of fundamental analysis, of just the global macroeconomic forces that shape markets and of human psychology. There's also intuition at play here, and that's something that you have to explore on your own, as it's just very difficult to teach this. So to recap, there are 6 market phases. Learn to identify them. Have different trading strategies for each one of them if you want to trade them all, but you don't have to. You can simply stay out of the market when the current phase isn't favoring your trading strategy. But all in all, this is how you stay on the right side of the market, and this is how you maximize your chances of success in trading.